Good morning from Cannes. We're here at CBRE's European Investment Briefing. I'm here with Nick Axford, Head of Research and Consulting for EMEA. Nick, you were talking about record investment flows into Europe in 2007, flows into continental Europe at record highs. Which European markets will be popular with investors going forward this year?
I think, given the way that the market's changing, it's likely to be quite a strong focus on those that are seeing stronger economic growth and the more mature, liquid markets in Western Europe. We're still seeing a lot of interest in Germany, Scandinavia, because of the very transparent market that we see there and actually relatively stronger economic growth coming through. Clearly, France, the very, very positive outlook for the underlying fundamentals in the Paris market means that all of those are likely to be, seeing pretty strong interest. I mean, clearly there is a risk out there. The economic growth is likely to be slower than we previously expected it to be. But on the other hand, the fundamentals still look pretty positive. What's interesting is that we're already seeing quite strong overseas interest coming back into the central London market after the very rapid repricing that we saw there. German open-ended funds and Middle Eastern capital very active in the market at the moment looking for opportunities.
And what about US investors? Obviously they're having trouble in their home markets, but do you think they'll be as active in 2008 as they were in 2007?
That's difficult to say in terms of absolute levels of volume. I mean, certainly there is still a lot of interest in the market from a US perspective. A number of the funds that went in earlier in the process will probably be looking to make some tactical sales. At the same time, a lot of the US investors have been very savvy in identifying opportunity in the market, and I think that the repricing is certainly going to mean, in some markets, is going to mean that they're going to find some attractive opportunities. Albeit that a number of the other funds, particularly some of the opportunity funds, have tended to use quite high levels of debt, and with the reduced availability and the lower debt loan-to-value margins that they're able to secure at the moment, perhaps some of those investors will be a bit less active.
And everyone's talking about Asia this year, and Europe is now a very, very established market, but people are looking to Asia for higher returns. Do you think that interest in Asian markets will detract away from Europe going forward and basically detract people's interest from investing there?
I'm not sure necessarily will detract interest. Clearly, the very strong economic growth that we're seeing coming through in a lot of the Asian markets means that a lot of investors are focused there. They're trying to identify opportunities, looking to build their portfolios there. Although in relative terms, the markets there are still quite a lot smaller than they are in Western Europe. I think one of the key features of the credit squeeze is that what it's highlighted is a real reassessment of risk. And when you look on a risk-adjusted basis, although a lot of the Asian markets are likely to show quite strong returns, on a risk-adjusted basis, you do need to take that risk into account. Clearly, within the investment community, we're seeing an increased focus on global investment, people building global portfolios. So it's inevitable that a lot are going to be focused on Asia. But clearly, with a repricing of risk, with more opportunities potentially available in Western Europe at higher yields than previously, if anything, what's happened may mean that we see more interest from global investors in Europe than we may have done otherwise.
And what about London? Is that a market that's stabilising after a rocky few months?
It seems to be. We saw very rapid repricing there and very low volumes during the fourth quarter. But the signs are that we are seeing some price support at the sort of levels that we're seeing at the moment, around 5% for prime in the West End, 5.5% in the city. We are seeing German investors coming in, we're seeing other investors. So I think there is some price support there and more activity than was the case previously, particularly as a number of the open-ended funds have been quite motivated sellers in the market over the last couple of months. So the combination of product and capital means that we're seeing a bit more activity. Still very early days. We're certainly not putting an overly optimistic view on things. It is a tough market out there at the moment, and we expect it to remain so for much of it, at least the next 6 months. But certainly more encouraging signs than we were seeing at the tail end of last year.
Okay, thank you very much, Nick. Enjoy the rest of the week.
Thanks very much.
Now I'm here with Ray Torto, Global Chief Economist for CBRE. This morning there was a lot of discussion about the global economy and the news from the US is that the economic situation is worsening. What is the likelihood of a global recession over the next year or two?
I think the likelihood is very close to zero. Our thinking is there's going to be positive growth. It's going to be driven primarily by above average growth in the Asian markets and below average growth in the US and in Europe. And I think that assumption that what we're talking about that underlies, I should say the assumption underlies our analysis, is that the debt markets will, because of policymakers and because of the cooperations of the central banks that we read about this morning in the newspapers, will bring rationality back to the debt markets. And so if that rationality does return, I think we will avoid a global recession.
When do you see that happening?
Well, it's starting to happen right now. We're going to have to see it evolve over the next 30 to 60 days. I think we're going to need to see in the States one more major policy initiative, which is going to be how to deal with many homeowners who have negative equity in their homes. And it's my understanding that is being discussed in the administration and Congress. So, our view about the economy and what we think is going to happen, not what may happen, we traffic in what is going to happen, is that with these policy adjustments, we will see no recession.
Over to China, economic growth there is slowing, and exports to the US have slowed dramatically. Do you think that trade between emerging markets is going to be enough to sustain the economies and the property markets there?
In China?
In China.
Well, I think China is slowing, but they're slowing from high single digits, double digits to 7-8%. That's pretty strong growth, nevertheless. And so that will sustain exporting, that will sustain the property markets. And in our discussion here today, part of what we talked about too is that the investment universe over there in Asia is actually quite larger than the amount of money that's been flowing into Asia. So investors have not really stepped up there. They're still a little cautious, and there's a lot of transparency issues. There's a lot of caution. So there's also a lot of opportunities.
And what factors do you think will stimulate increased investment flows into the region?
Well, the investors that I talk to need to feel comfortable with transparency, and by that they mean they understand the laws, they understand the politics, and they understand the markets. If you come from the States, you come from Europe, as you saw in Nick's presentation this morning, there's a lot of information, a lot of analysis available. They'd like to be able to do that in China, they'd like to be able to do that in India, they'd like to be able to do that in other parts of Asia. That's difficult right now, and so that slows down the volume of investment. And what we've seen in the States and we've seen in Europe over the last 15 years, as transparency grows, investment volumes grows. So that's what we're waiting for in Asia.
Another thing you were discussing this morning was the CMBS market in the US. It seems to have a particularly bleak outlook on property. Do you think that's fair?
No, I think it's irrational. And it's irrational, and the analysis that we've been doing and what we've been providing to our clients is that, if it's irrational and we can show you that based on the fundamentals of real estate that there are opportunities here, we'll just step up and do it. And what we've seen actually is a lot of our clients have taken money out of equity and they put that money into debt. And they're starting to buy some of these high-priced CMBS. And the reason they're doing that is they're saying, look, I know the real estate. I know this real estate credit is good. I know the fundamentals of the real estate market's good. The market in debt is irrational, so why don't I step up and buy something that yields me a mid-teen return? And that's what they're doing. And I can think of one client in particular was allocating money away from equity into debt, and smiling all the way.
Thank you very much, Ray, for
Lucy,
your time this morning.
Nice to see you
Good to
again.
see you. Take care. Bye-bye.